Digital Swordsman here. It's June 26th, 2022. I'll just keep on reiterating some concepts that I think are very important, and especially at a time like this. I mean, right now, sentiment is in the toilet and has been. I mean, basically, sentiment has gone down since late 2020. That's a long period. That's soon to be 2 years of a declining sentiment and declining valuations. Not that gold has declined for 2 years or has, sure, it's down, but not even down a lot. I mean, the value of the gold business is still high, but it's not, at any given point, it's not the fundamentals or value that dictate price, it's sentiment. I mean, that's one thing that should be, I mean, if anything, this downtrend has taught anyone, it should be just how important sentiment is. That it's basically, in the short to medium term, it's like, I don't know, 70% of the overall stock movement or something. I mean, the best stories, they kind of have stayed neutral or something, even though they've kept on growing and added value. But so it's like, once you see this, once you see what's happening right now, I think that's a huge benefit to anyone who's, who's expecting to be investing for a long time. Appreciate what is happening, see it for what it is, and use that, incorporate that. Stop thinking that the market is an efficient pricing machine, especially in the short to medium term. This should now be beyond obvious that stocks go down when people feel more like selling than buying, and they go up when people feel more like buying and selling, almost regardless of the actual valuations. Because at the peaks, we have incredible appetite for risk. People will gladly pay for blue sky scenarios. People will gladly pay for long shots, etc. Right now, everybody thinks everything is risky. They talk themselves out of buying. Stuff gets cheaper and cheaper. And they don't sell because they think they're overpaying for something. I mean, I recently had a quite interesting conversation, I think, with a fellow on Twitter. I really like him. But he basically said, I think he got into juniors around. This is, of course, my proxy for junior sentiment, one of the proxies I use. I think he started buying around here, perhaps, in juniors. And now I saw him say on Twitter that he's now refusing to buy juniors because they have performed so badly since he started buying them. That's very, let's say, human to do. Because at face value, it looks like nothing is working. And it hasn't worked for almost 2 years. Quote, worked. Meaning that you've only seen your decisions to buy lead to a paper loss for 2 years straight. So that probably makes you think that there's something, this sector doesn't work. You can't make money in this sector, or you're doing something wrong, or whatever. But like I just said to him, if you translate that to investing, what he basically says, or is, pretty much doing, is that he was happy to buy here, but after this downtrending action, now he refuses to buy. So if you look at it, what actually happened there, or what is his decision leading him to do? Buying high, and then he's refusing to buy low. Obviously, you should do the exact opposite. I'm not a trader, but if you were a trader, because I'm always, 100% long, but what he wants to do is the complete opposite of what you obviously should be doing. if you didn't have any feelings, you wouldn't do what he did. If you just looked at the opportunity, the price to value gaps, you would be a lot more inclined to buy here than up here. But what people do is do the opposite because how they feel about it. Because if you look at this chart, for example, since, I don't know, 2006, 2007, this particular stock has only at a few times been at this level here or lower. And the lower, when it went quite a bit lower from this level, what happened afterward is that I think it went up 2,600% in 2 years or whatever, or 3 years maybe. That's what I also keep saying. I mean, I tweeted about it. Has anyone seen one junior, a real leg up in juniors? This is, quote, a boring company. This is a prospect generator. But you still see that, I mean, from the lows of any of these moves, it doesn't go up less than 100%. And the more exciting micro cappers, let's say, or juniors, they go up a lot more than 100%. So people think, I don't know where that comes from. I think something, I don't know, it's just instinctively, I guess. They believe that, let's say, if you're down 50%, that's a catastrophe. You can't change that. Now, irreparable damage, basically. But if you look at history, that's simply not the case. Because even if you're down, I don't know, 60%, let's say, or more, in your entire portfolio, let's say you're quite diversified, and you haven't, had many good performing stocks or whatever. I mean, if you're down 50%, 100% return from there is equal, puts you at neutral. And people complain like, yeah, I would need 100% now to get even. Like that's some, miracle to get 100% to become even. Yes, it sounds a lot because all you've seen over the last 2 years is that they have only gone down. So 100% to the upside feels like almost an impossibility because you have seen no evidence for 2 years of a junior having an easy time doing that. But if you actually look at history, when these long downtrending cycles, and they tend to be longer than the I mean, they take a longer time falling than they take retracing the moves, for example. The up cycles are shorter and more violent typically, and the downtrends are more grindy, etc. 100% return is nothing when we go from a sentiment bottom, especially an extreme sentiment bottom, to the next sentiment high. 100% return is nothing. Let's look at this. Okay, here you bottom ticked it. Let's say you bottom ticked it. I mean, you can see the percentages here. Even if you're down 70%, that's not a problem really. Not a problem at all. I mean, again, like I've shown a few times before, I've been down over 50% 3 times since 2015. And in the end, it doesn't matter. Because every upturn I've been a part of takes my portfolio way up more than 100%. So just think about it. Let's say you go down 50%, then you go up 200%, then down 50%, then up 200%, then down 50%, then up 200%. You're gonna make a lot of money that way. Despite the fact that your portfolio will be cut in half, let's say every 2-3 years. So if anybody looks at any chart for let's say a trading sardine, etc., you should realize that every leg up from a sentiment low takes many juniors up way more than 100%. So if you're down 50% right now, I mean, most people, I think, throw in the towel, thinking they've done something terribly wrong, it's never gonna go up. For 2 years, you're not seeing it go up. So people quit. They don't have the discipline, etc., to actually realize that there are two things we can know. That's price we're paying and that sentiment always change. And that's also why I like to be diversified right now. I'm more diversified than ever. Why? Because I think the opportunity is better now than it was here, 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 or here. And it might still get even better. We might have something like this. Juniors might get flushed for 30, 40 more percent more. Who knows? I just know that the lower they go, the higher they will go afterwards. What do you think? What you should be thinking about, I think, is how do I set myself up now to make them have the best possible return when we go to the next sentiment high, however long away that is from now. Because otherwise, the option is that this downtrend will continue forever in juniors, and the mining sector will disappear. Nobody's buying gold, nobody's buying silver. The mines that are operating, they shut down, or let's say flip side is that future supply will not be needed because all the mines that are operating today, they will in fact not be finite resources. They will just find forever more gold. Those things are simply not true. We are mining more than we're finding every year. We're mining more than we're putting into production each year. So future supply, despite the action in the future supply, which is typically the juniors, is going up. And central banks are buying more gold. And now I think they're banning, Russian gold to get into the Western system, something like that. And you see central banks buying more gold. And you see, I think, coin sales are up. So the demand for gold and silver is actually increasing. The need for future supply is increasing. The price of gold is at 1830, for crying out loud. But still, the future supply, which is affected by all of that, those are positives for the future supply. They are all going down. Have been for 2 years. So this is the best opportunity I've ever seen. I get the fact that, what we are afraid of is not that right now people are not afraid of them owning overvalued juniors, typically. They're afraid of a greater fool selling even lower tomorrow. Right now we are afraid that somebody tomorrow or next week will sell down our stock even more. We are afraid that cheaper will get even cheaper. But the thing about that is that it's kind of an irrational fear, because nothing ever stays cheap forever, and nothing ever stays expensive forever. They go from cheap to expensive, to cheap to expensive, to cheap to expensive, to cheap to expensive, to cheap to expensive, and will do forevermore. So just that knowledge that we know that the sentiment right now will completely flip one day. And an ounce in the ground that's maybe valued at $20 per ounce today might be valued at $80 per ounce in 2 years. The moves in prices that comes from a sentiment change like that, that's what I really want to be a part of. And it's impossible, I would say, to have really good long-term results if you're not buying cheap and low. So why on earth, if you look at this chart, it's like I did a tweet. Nobody wants to buy this low, and that I made that tweet simply because I look at sentiment right now. Sentiment is in the trash. Nobody wants to buy this, and that's pretty much a fair statement. Nobody wants to buy this low. But if you ask someone who had not been in this mining sector or junior sector for the last 2 years and only looked at this chart, and you asked him, would you be a buyer or seller right now? What do you think that person would say? If he had, half a brain, he would obviously see that, my God, prices are almost never this low. This sector is almost never this cheap. This is like one of the, opportunities like this might happen, 5% of the time, and 95% of the time it's trading higher than it is now. So, I mean, those are, it should be absolutely clear what you should be doing right now. And I'm not saying you should be all in on one stock or all in on juniors or whatever. You shouldn't risk everything. I mean, anything can happen, and the problem with timing is that this was a bottom grind that lasted for almost 2 years, and this was, a downtrend for many months. So it's like, that's why I don't like leverage. I don't like to invest money I will need in a given time frame, because let's say you bought here and this was super cheap. But if you needed your money here, I don't know, let's say, 10 months later, you would be selling when you should be buying even more. That's what I don't like about timing. I like the whens, not the ifs. And this is, it should be pretty obvious that you should not be, you need to break the cycle of buying high and then refusing to buy low. Because you're just gonna, the person that refuses to buy down here is just gonna get into another sector that is close to a sentiment high, and then they're gonna repeat the cycle of buying high, refusing to buy low, and probably sell low to buy into a sentiment high in another sector. And it's like I also said to someone, the whole reason I can afford to have 50% corrections is because I've been 100% long from every bottom. At every bottom tick in the junior sector. Not that I bottom tick with my buys, it's just that I'm 100% long from the very, very lowest point here. So I get this entire movement. And since I'm in growth, they tend to, have higher lows and higher highs. But you can afford 50% corrections if you're 100% long from every bottom, because like I said, juniors from bottom to top, they go up way more than 100% on average. Way more. So a 50% paper loss right now at an extreme sentiment low, that's nothing. I mean, look at any market. That's basically nothing. And that's why, again, I also like diversification right now. First of all, because the world is so chaotic and you see stuff happening all over the place, jurisdictions change, ESG, mines having a problem getting, up and running, and you see cost inflation, whatever. So it's like, I mean, if you're highly diversified at a sentiment top, it's gonna make sure that you catch the full, brunt of the decline. But the flip side is, of course, that if you're diversified at the bottoms, you have a very high probability of being part of the next wave up. So it's like, it's harder to invest here, because here you actually have to dig a lot to find something that might not go down, 70% at the next sentiment bottom. But some companies take, I don't know, well, SK has gotten sold a bit more lately, but if you look at a 1 to 2 year graph of, let's say, Loro, SK, they've mostly gone sideways. So that's still outperforming the typical junior, which is down 70% or whatever, or 60 or 50. So it's like, some of the, I'm not saying that SK, was cheap over that entire period, but let's say high quality stories with a good narrative, etc., chasing high grade stuff, etc. I mean, those just staying flat when most stocks go down, that's still winning. You're outperforming, because when they turn, if you own a company that's flat for 2 years and then we have a sentiment high, I mean, that's just, it goes up, then plateaus basically for 2 years, and then you have the leg up. That's a really good turn of events. And like I always also say, it's like, you shouldn't be throwing up your hands right now and not care about miners and just, I mean, it's better, in my opinion, to take, let's say, a 6 month vacation and not even look at the portfolio. But there's a lot of things you can do at sentiment lows, because what happens? People sell for no other reason than they're scared and want to sell. And that goes for high quality juniors, low quality juniors, medium quality juniors, etc. So, I mean, you can completely change your portfolio at any given day, because there might be some stories that have done nothing in terms of adding fundamental value, but they're down 60% or 50%. Some should maybe be up 50%, but are down 50%. Obviously, that both are down 50%, but the future expected returns for the latter, which has increased fundamental value, is a lot better than the other one that's down 50%. So even at face value, yes, you're sitting at a 50% paper loss in both. You could still sell the paper loss in the company that has not increased value and buy that and use that money to buy shares of the company that has actually increased fundamental value by 50% and still is down 50%. So again, it's at face value, it does nothing for your portfolio right now. Nothing at all. Again, let's say you own two stocks. Well, both were down 50%, so your portfolio is down 50%. The thing is that the one of the stocks that has increased fundamental value is going to go up 400% in the future, and the one that has decreased it is going to go up 100% thanks to sentiment, let's say. So if you take the money at 50% loss in one that's expected to go up 100%, and put that in the one that's also down 50%, but it's expected to go up 300%, then your new expected future return in your portfolio is not half of 100% plus half of 300%, it's 300%. So you materially changed the expected future returns of your entire portfolio, even though at face value nothing happened for your portfolio in the moment, because your portfolio is exactly down 50%. But the path forward for your portfolio is completely different. And that's why I like this quote. I think it goes something along the lines of bear markets is where your biggest returns will come from, but you just can't see it at the moment. That's basically what that is. So I see when I'm 100% long all the time, most of my stocks go down, if not all, at a decline. But then I can reshuffle it and set myself up even better. So it's like, people complain right now when I get that good news doesn't get rewarded by the market. And that's true. And bad news gets, typically heavily punished. But yes, it's frustrating if you are a holder in a company, because it looks like you're taking on risk without reward. Because you're taking the risk that results will be bad, but even if they're good, you don't get rewarded for it. But if they're bad, you get punished a lot for it. So at face value, you are playing a rigged game, basically. Damned if you do, damned if you don't. So if you have a company that drills a monster hole, it only goes up 14%. The odds of them drilling a monster hole should have them probably up more than 14%. But that's what it is right now. Nobody's willing to buy anything because everybody's thinking that value is not valuable right now, because they don't see Mr. Market rewarding value. But it will someday. So yes, from one perspective, it's extremely frustrating because it looks like you're getting punished. It looks like the game is rigged against you. But if you think about it, if you have dry powder or whatever, there's never a better time to buy than at sentiment lows, because you can buy value after the fact without really paying up anything, and more importantly, not even taking the risk. So this is a buffet of opportunities right now, because even the best stories don't get revalued higher. So you can steal an incredible amount of value. And my currency, since I'm 100% long most of the time, is other cases. So if I have 10 cases and you see 3 of those cases, they have had great success, but the share price is only up 10% or neutral, let's say. And then you have a lot of companies that didn't have such great success. Let's say you have 3 that didn't have such great success. So they're down like 30%, whatever, from a given time point. Yes, that if I use that to buy the ones that have gone up, yes, my currency is less because what I'm selling is down 30%, and I'm buying something that's, let's say, neutral. So it's face value. It's like, man, I don't like, taking a loss here, especially since what I'm buying is not down as much. But the thing is that even though, yes, you're you're making a loss permanent and buying something else, maybe the expected future returns of what you're buying, more than makes up for the fact that you sold a depreciating asset to buy the better story. So it's like there's always stuff to do, and that's why it's like if you're simply a value investor, or just along the lines of buy low, sell high, there should be no confusion what to do right now, because it doesn't typically go much lower than this, and if it does, it's always limited in time. And if it goes lower, the lower it goes, the higher it will go afterwards. We're gonna have a bottom sometime. I don't know when, but it's gonna happen. We're gonna have a bottom. This will not continue forever. So we're gonna have a bottom, and that's enough. And if you're a buy low, sell high, should be no confusion what to do. And it doesn't really matter, in my opinion, if you're down 50% or whatever, because you can steal a lot of value right now, because there are stories that are near peak valuable because they've, had success and success and success, but the market has not rewarded them yet for it. But you can sell something that, again, is like have done poorly or nothing has happened or whatever, and you can buy stuff that's gonna go up, I don't know, 500% instead. So I mean, if you sell something that's down 60% and buy something that's gonna go up, let's say 500% at the next peak, you don't have a problem, because that's more than gonna make up for your 50% downtrend. But if you are unwilling to buy low, incapable of buying low or holding low, you cannot afford 50% declines. If you're always buying up here, and you catch let's say you buy here and you catch a 30% move up, then you get see through a 50% decline, and then you sell out, and then you buy and up 30% and 50% decline. You're gonna seesaw yourself to oblivion. So if you want to be able to afford to not be a, let's say, a market timer, you have to start buying low or holding low at least. It just goes without saying. Yeah, I'm we're still in a shitty sentiment environment, and like always, I have no idea when it's gonna turn. Absolutely no idea. The bottom might have been on Friday. We don't know. The interesting thing is like on Friday, gold was around minus 0.5% for most of the day, and miners got slammed big time. Big miners, small miners, juniors. But like, this feels a bit like the 2015-16 bottom. I remember this period very well. Metals were barely down here, and I saw some of the highest quality miners sell down 6 to 10%. So a massive overreaction. Probably because it broke this support, so people got even more scared, and I mean, it was already no-brainer sheep here. But then you had this break, and then everybody just started selling. And that was, within a day or two, that was the exact bottom. I'm not guaranteeing this is going to be the case. I'm not using this to realize that this is low. I'm not putting up these charts to like, yes, I'm buying or bullish right now simply because I think this is for sure gonna happen. That this is gonna be a fake breakdown and then we're gonna go up. I have no idea. All I know is that everything is dirt cheap right now, and that's my only criteria for buying. If it's dirt cheap, I'm buying, I'm not selling. Regardless of the short looks. Regardless of how many are pissed off about this sector. I mean, there's barely any bulls left. Almost nobody is bullish miners because they don't think they've seen 2 years of a declining price. So they're thinking, why should I be bullish about this sector that's gone down for 2 years? Well, you should be if you realize that investing is not about the past. This is, what has happened in the past is already, ancient history. It doesn't matter. It's how good, people talk about opportunity cost. Let's say you didn't know this sector at all. You just saw, found this sector, and all of a sudden you found this sector and it's trading here. What's the opportunity cost? If you ask the people that have been in the sector, they're complaining about the huge opportunity cost in being in juniors, and that's why they're not buying right now. But opportunity cost is not about what has happened. It's about the current risk reward at any given point in time. So if you look at this chart, what do you think the opportunity cost is here? Do you think this is a good opportunity? And we're not talking guarantees. What is the risk reward here at this level? In light of this chart since 2006, would you say the risks are to the upside or to the downside? I would say the opportunity cost is incredibly high in the juniors right now, thanks to this decline, not despite it. This decline that took it down here made the opportunity cost go up and up and up, and now it's very high. But people use opportunity cost in the wrong way. They look at this past and say that, hey, in hindsight, this has gone down, and I call that, opportunity cost. So that's why I'm not going to buy now. Opportunity cost is not a period of time. Opportunity cost is at any given moment. If you had $1,000 or 10,000, you could buy anything. So you have to weigh every opportunity against each other. And I would say that there are not too many sectors that are this undervalued right now. So by default, if you're a value investor, that means that the opportunity cost is very high right now because it has gone down, not despite it going down. The opportunity cost kept increasing the lower it went. So seeing this is not a good reason for not buying. A bad past is actually a reason to buy. That's what most people will never, they will get it instinctively. I mean, if you ask people, they understand it. It's just that we don't act on it. And that's the same thing that I've been talking about. It's like everybody knows how to get in shape. Everybody knows that you should eat less and exercise more. It's not the knowing what to do that is actually the hardest. It's doing what you know you should do. Why should investing be any different? People know you should buy low and sell high. People know you should buy cheap. In anything, everybody wants to buy cheap. You want to buy an apartment cheap, a car cheap, whatever. Everybody knows that cheap is good. But very, very few actually act on that fact. Again, right now, I don't think it's not a moron could see that this sector is cheap, but there will be very few that realize it and act on it. And if it stays cheap, even fewer that will actually still believe that it's cheap, if you know what I mean. We are our own worst enemies, and things that are blatantly obvious uh, opportunities in this case, we mess them up because we're human and we start investing based on feelings instead. We look at the past and why did the person that bought here not want to buy here? He bought here because he had seen this. He had seen the good times. He felt good about it. The sector was in an uptrend. Then he turned over. Why doesn't he want to buy now? Because he's looking at this past. So you have to break that cycle of looking in the rear view mirror and making decisions about your future, about the future. A bad past creates the good future. A good past creates the bad future. So what am I doing now? I'm waiting for us to get up here. And in the meantime, I'm just trying to follow every story and see, okay, what juniors are creating value. Is there something I can sell that's, let's say, down 50% that hasn't really, done well, or down 70%? Maybe I find something that's a store that, well, hey, the fundamentals of this store is at an all-time high, but that's still down 50%. I mean, that's an obvious opportunity arbitrage. Yes, you're taking a loss, you're selling something at a loss, and you're buying something else that's down. But the futures for both stores are completely different, because one has maybe had a value curve that's looked like this, and the other one has a value curve that's looked like this, but they're all down here. So I mean, both are down here. So I mean, the gap from here to here is obviously less from here to there. And if this stock keeps on performing and this one does not, let's say, I mean, the more time you give this success story that's growing every year, I mean, the longer you wait, the better your absolute returns are going to be from this point. So this is no time to be lazy. This is no time to just throw up your hands and admit defeat. And I mean, that's quitting. That's quitting. We're not quitters here. So I'm not saying how or what you should buy, whatever. Or it's like always or never risk money you cannot afford to lose, of course. And you should always have physical gold is my hedge to my gold portfolio. If the world burns down, it doesn't matter what you own really. Uh, so it's like, yes, the the main anchor of everything is your physical stash. So it's like, I think you should have that first and foremost, but unless if the world doesn't end, I expect my junior portfolio to do very well as my gold actually. But if everything absolutely turns to shit, it doesn't matter what stocks I own. And gold should probably do very well. So I'll probably be better off than 95% of people that doesn't own any gold anyway. Just from my small stack of physical relative to my junior portfolio. Yeah, a lot of rants as usual. Uh, Not investing advice quote, but it's like, think about what's actually going on. Again, is right now I don't think. Yes, you should do due diligence, but it's like how to think at extremes. I think these concepts are way more important than understanding geology right now or being a mining engineer, because this is how markets work. And just understanding how much sentiment plays a part is like that's such a absolutely enormously important point. So you have to think about why you started buying high in the first place, and think about the irrationality of refusing to buy here. And if you keep on doing what you've always done, you can just, you know, fast forward your future portfolio. How's that gonna do? If you always buy here and refuse to buy here or sell here, and then you buy up here again, etc. You obviously you're gonna lose money. But if you just bought here, here, less up here, bought more here, 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 obviously you're gonna make money. So it's very obvious what to do. The hardest part is actually doing it, and that's up to you. Nobody can hold your hand. It's you that are doing the buying and selling decisions, and it's like, not doing anything. That's a decision as well. What I would not be doing now is selling, and that doesn't mean that I know that it's not going to go down here first. We might very well have a crash like, a final flush like 2008. But who cares? I mean, if you bought here and it went up, a lot, does it really matter that much? The obvious mistake in any scenario would be if you sold at any point here, especially down here. So the lower this goes, if we go down here, that makes it even more obvious what I should or should not do. Selling becomes exponentially worse. Holding becomes exponentially better than selling, and buying becomes exponentially better than holding, and way more than selling. So I already know that if I can't sell here, and I should be buying here, that decision becomes just more obvious the lower this goes. So I'm like I've done a video about before. I'm waypoint the past of we're waypoint I think the past of selling, because this is now just gonna be how low do we go before this goes up. So I'm gonna make money on this buy here, and if I have some dry powder, let's say, I'm gonna make even more money if it goes down here first. But this is gonna go something like that, and I don't know if it goes like this or like this or like this. I don't know. I just know that everything is cheap right now, and cheap is gonna get expensive one day. Thanks for listening. Hit the like if you like my videos. Bye.